Welcome to PlanStrongerTV. I'm your host, David Holland. How's your IRA IQ? If you've got questions about individual retirement accounts, you're not alone. On today's program, I'm going to tackle some of the frequently asked questions about IRAs. I'll also share with you how they can be used to help save, produce retirement income, and leave a financial legacy for your heirs. Ready? It's time to plan stronger. All right, welcome back. So IRAs, look, this is a complicated subject. I'm not going to kid you. I've spent over 20 years working with finances and planning people's future and working with various types of retirement accounts. And without question, IRAs can be very confusing. There's different types. You've got how you get the money into them, 401ks, 403bs, all the different types of employer-based retirement plans that you contribute to and then can roll into an IRA. You have the IRA that you put your money into as you go. Then there's this whole new thing about converting to a Roth, and then what happens when you die and what happens to your IRA. Did I say it was complicated? It can be. So I call this program today, How's Your IRA IQ? Because it almost seems like we have to really focus and study this area of IRAs to understand how it works with our situation. And a week doesn't go by where I'm not answering questions about IRAs. So I want to dig in a little bit about IRAs, talk about the different types, talk about how to work with them, and how you can make the most of them in your particular situation. So first, let's do this. Let's talk about 4 of the most common types of IRAs. There are more than this, but I want to cover the ones that I encounter and people encounter most often. First is what's called the traditional IRA. A traditional IRA is the IRA that you make contributions directly to your individual retirement account. Now, the amount you can put in is based on several factors, not the least of which is what the current tax policy or tax laws are at the time. Depending on the year and what we are doing as a country with taxes may affect whether or not contributions can be made to a traditional IRA. There's also some inflation factors built in, and income, how much money you make. Ironically, the more you make, the less you can put in. Okay, how's that for backwards? And if you have the option or you're eligible to make contributions to a retirement plan through work, that can also affect your ability to make a contribution to a traditional IRA. But basically, a traditional IRA is when you put the money in to an individual account. It doesn't have anything to do with anybody else, and you get to take that off your taxes as a deduction. It reduces your income. The second type is what's called a rollover IRA. Now, this is where the money is. This is where a lot of money is in IRAs. You have your 403b, your 401k, your money purchase plan, your profit sharing plan. I'll try to think of all the ones I know. There's a bunch of different types of retirement accounts at work. A frozen pension plan where you've got the ability to take a lump sum. Pretty much all of that can be rolled over, that's where it gets its name, rolled over into an IRA. When you make that transfer, if it's done properly, there's no taxes on the transfer because you're not trying to pull it out, you're trying to roll it over. So you roll from these various accounts into an IRA. So that's a rollover IRA. Once it's in there, then it stays tax deferred until you take it out. The third type of IRA is what's called a Roth IRA. A Roth IRA is a special type of IRA where the tax has already been paid on the IRA. You say, well, wait a minute. I thought an IRA was an account where you put the money in and you haven't paid tax yet. It grows tax tax deferred, and then you pay tax when on the back end when you take it out. All true. But a Roth kind of takes that and flips it around. You pay the tax on the front end for a Roth IRA, and then the earnings aren't taxed, and when you take the money out, it's not taxed. So pay up front, and then everything that ever comes out of a Roth IRA, if you follow the rules, and this is all based on current tax law, everything that comes out of the Roth, there's no taxation, okay? So that's attractive. You can take a regular IRA and convert it to a Roth. There are certain requirements, including paying the tax. And you can also start out making a contribution to a Roth IRA. So there's a couple different ways of getting to a Roth IRA. It's attractive. The obvious drawback is you've got to pay the tax. So it is definitely part of an overall financial plan considering a Roth. The fourth type I want to kind of make as part of our summary introduction is the inherited IRA. Now, what's interesting is an inherited IRA is when the person who owns the IRA has died. That IRA then will go to the beneficiary. That might be a spouse, or it might be whoever else. So if you leave your IRA to a spouse, then typically what happens is that IRA becomes that person's IRA. It's a spousal rollover. But when you deal with somebody besides a spouse, it becomes an inherited IRA. Now what that means, if you kind of boil it down, is that that IRA still can stay an IRA. It still is not taxed yet. And the money is held, can stay invested, but then the person who has inherited it, if they've done everything correctly, they can draw that out over their lifetime and make it part of their own retirement. So an inherited IRA can be used as a way to continue to defer paying taxes on an IRA and have that money go to the beneficiaries. So it's an attractive feature. If it weren't for the provisions in the tax code that allowed that, the entire IRA balance would be taxable to the beneficiary. Can you imagine? Somebody inherits a $100,000 IRA and they have to pay tax on the whole thing? That would be horrible from a tax standpoint. So thank God for inherited IRAs. All right, next up I want to talk about why you want to roll an IRA or your money into an IRA. Why you want to roll a 401k, 403b, any of these retirement-based vehicles, roll that money into an IRA. There's a couple of key reasons. First, if you're able to roll it from a 401k to an IRA, you get access to a lot more choices. In the typical 401k, you have a range of choices, but usually there's not that many, and you don't have a lot of control of what's available. You kind of have to pick from the menu, right? Well, if you've separated from service, you've left that job, you're 59 and a half, usually this is an option, or some other triggering factor has allowed you, given you eligibility to move your money out of your 401k into the IRA. I usually recommend doing that because you've got more choice, you've got ease of consolidation and reallocation. What that means is you can take multiple 401ks and IRAs and move them over into one IRA. So let's say you've got 4 different 401ks from various employers. You could roll each of them into an IRA and get that consolidated. And by getting one account, it may open up your investment choices and give you more flexibility. And it may give you the ability to split that IRA up. Maybe have one IRA that's the money's safe, maybe one IRA where it's still invested in the market. So it creates some flexibility. Now, next I want to talk about the fact that it's an IRA. That opens up what I mentioned a minute ago about a Roth conversion. So you can't really convert a 401k easily into a Roth IRA. It's first really got to go from being a 401k into an IRA and then an IRA into a Roth IRA. So it opens up some choices, and a lot of times people will convert their IRA into a Roth over time because, again, remember the key requirement for converting to a Roth, you got to pay the tax. And then the last thing about the rollover and converting from a 401k or similar type of employer-based retirement plan going into an IRA, fewer rules. The IRA rules are established and they're the same for everybody. 401k rules, the regulators, the government allows a little more latitude, so it's a little easier to work with an IRA. And there's also more estate planning options. You can give your beneficiaries more choices on what they do with the money. Now, the other thing that's important to know about IRAs in general, when you get to 70 and a half, the year you turn 70 and a half, you have to start drawing money out of your IRA. Well, actually, technically, you've got until the April of the year following the year you turn 70 and a half, but for most people, they start drawing it at 70 and a half. Because if you wait the next year, you've got to take 2 distributions. So usually people will draw from their IRAs the required minimum distribution that's set by the IRS, the tax code. They start drawing on that when they're 70 and a half. That first year, it's usually about 3.5%, 3.5%, 3.6%. Now, you can make that be a little more efficient if you've got your money into an IRA instead of having multiple accounts, 401k, 403b, IRA. Again, it makes it easier to plan. I like being able to do it with IRAs. You take your required distributions, do that each year. The IRS doesn't say which account you have to take it from, which is why I like having a couple different IRAs. You can draw from the one that is more stable and let the one that's more growth-oriented with the investment more risky, maybe more volatile, let that one grow. So draw from more stable, let the other IRA grow. The IRS just cares that you take the correct total dollar amount or percentage from the total IRA balance. Now, the next piece of this is that with an IRA, and again, having multiple IRAs that I think is smart, is you can get what you need. You know, if you need more than the required minimum distribution, you can draw what you need from where you need to get it. The whole point about required minimum distributions is making sure people take at least a certain amount of money out while they're alive. Why? So we can tax it, of course. So you get a 1099. That's the whole point of a required minimum distribution. And that required amount will go up each year. Now, the next thing is intergenerational tax planning. I know it sounds like I just started talking another language. Intergenerational tax planning is when we look at how much you're required to take out of your IRA because of the required minimum distribution, and every year that percentage goes up. You know, it's 3.5 or so at 70.5, it goes up 3.7, 4, 4.2, 4.3, 4.5, it gets up 8, 9, 10% that you're required to take out. Well, instead of following that tax plan from the tax code, you can also take out more than you have to. You say, well, David, why would I do that? I don't want to pay tax. Well, sometimes it makes better sense to draw more than you have to, either because you think the taxes are going to go up in the future, so pay at a lower rate now, or your family is going to pay at a higher rate. What do I mean by that? Well, if, say, for example, you're in the 15% tax bracket, but let's say that your kids are in a much higher bracket. They have high incomes compared to yours. Maybe they're in the 30% bracket. I'm just using these as examples. You're in the 15 and they're in the 30. If you draw money out more than you're required from your IRA, it's going to be taxed at a lower rate. If you die still with a large IRA balance and they inherit that IRA, and if they do everything properly, they roll it over, it's an inherited IRA, they still are going to have to take money out. They don't get to wait until 70 and a half. They have to pick up basically right where you stop and have to start drawing out, and there, of course, is a tax table for that. So they will have to draw out a certain percentage. That withdrawal from the IRA is going to be ordinary income. That means it's going to be stacked on top of their existing income. So if they're in the 30% bracket and they add that IRA distribution to their existing income, you can see where I'm going. They're going to be paying 30% or more tax on that distribution from the inherited IRA. If you had taken it out, maybe it's 15, maybe it's 20%. So that's what I mean by saying intergenerational planning. Now, of course, to do this, you need to have a candid conversation. I mean, you can guess if if you know for a fact that the particular field or particular position your child has is very high income, then you might be able to make that guess. If they're a movie star and you know they're doing very well, they don't tell you exactly the tax bracket, and that's one thing, but you might want to have a conversation about what you're trying to do. And that brings me really to this idea of the inherited IRA, which is where I'd like to wrap up. The neat thing about the inherited IRA is that when you're done using that money, and again, maybe you've done all these things I've talked about, but there's still a large chunk of money, that money can now be part of your beneficiary's retirement plan as well. I just think that's so cool because they will inherit that. Now, there are rules to follow. It has to be done carefully. And if you are concerned about a child receiving the money and kind of blowing the whole plan up, in other words, they get the inherited IRA, they have a certain amount they're required to take, but if they want, they can take as much as they want. They can cash the whole thing in. You say, well, wait a minute, if they can do that, that'll kind of mess up the whole plan. You can use a trust, and again, consult an attorney for this, but there's a way to use a trust to kind of overlay the inherited IRA to make sure it's distributed out the way you want to keep taxes lower. Now, this is an introduction to IRAs. It's complicated, but complicated doesn't mean you can't do it and you can't leverage it for your benefit. And that's why I think IRAs are such an important part of an overall financial plan. All right, time for viewer questions. I hope you'll send me your question and I can answer it on the program. I'll change your name just like I did for this question I want to read to you. It's from Bob and Betty. That's not really their name, but it is today. So their question is, can you explain what a personal umbrella policy, also called a PUP, P-U-P, is when you and when you should consider an umbrella insurance, and what are the eligibility requirements for attaining a PUP? So, personal umbrella policy. First, let's start with the eligibility. This is typically something you would get from a property and casualty insurance agent or a home and auto or what's called a personal lines insurance agent. So if you have an auto insurance or home insurance, that's where you would generally get a personal umbrella policy. The eligibility really is that from an underwriting standpoint, from an insurance company standpoint, they're going to look at your situation and say, okay, why do they need this policy? Look at your situation. So typically what they're looking for from an eligibility is that, you have other insurance or other assets that this would work with. So let's say you have a couple of cars and you have a home, and then you say, I want an umbrella policy, because the purpose of the umbrella policy is to protect your assets from a large personal liability. So what we see sometimes is that the insurance agent will put an umbrella policy kind of to go over. That's why it's called an umbrella. It kind of goes over the homeowner's policy and the auto insurance policy and any other type of similar insurance. So it kind of goes above that. Normally, an umbrella policy will have a significant limit. They are sold typically with a $2, $3, $4, $5 million liability coverage. And the idea is that you are trying to protect an asset or assets. So let me give you an example of when you wouldn't be eligible and probably not need an umbrella policy is if you don't have a lot in assets. You don't have a lot to, quote unquote, protect. So do I think it's a good idea? Absolutely. If you have assets and you want to protect them, yes, it's good to have your car insured. Yes, it's good to have the proper insurances for your home, medical payment coverage, any liability coverage that goes with your home, of course, protecting the contents. But the umbrella policy really is about your liability. It's about protecting you from being sued or from a claim from somebody, and they're going after your assets. That's what the umbrella policy is for. Now, that's not the only way to try to protect and preserve what you've accumulated. You could do certain types of planning, working with an attorney, to structure your assets in a way to protect them more. Now, I always tell clients, and again, this is not a legal opinion, it's just maybe a reality check, nothing's bulletproof. I mean, there are different levels of assets that are protected. You know, an IRA, for example, or a life insurance policy, the cash value would be more protected than, say, cash in your bank account. So it's kind of a continuum or a scale of what things are more protected than others. And it depends on your state. You know, homestead property, things like that, greater protection. Thanks for the question, Bob and Betty. Send yours in and I'll answer your question as well, ladies and gentlemen. One more thing before you go. It's never too late to do the right thing with your money. You know, I've got a lot of stories from doing this work over the years, and some of them are very poignant, some of them are very memorable, some of them are lessons on finance, lessons on life. So I'll be sharing them with you. I hope to get to share a lot with you. One particular story stands out, and it's a story about it's never too late to do the right thing with your money. I had a couple that came to me for financial planning many years ago, and they were with me for a few years, and then they got, how do I say this the right way? They were lured away by promises of high return, daily attention, and trading, and growth of their money, and all these, all the things you might expect somebody might say to lure somebody to manage their money. In any event, they liked what they heard, and they left. We left on good terms, but they left. Well, a few years ago, they reached back out to me. The husband called, we'll call him John. John called and asked to speak with me on the phone. And so I got on the phone, and he said, "I need to see you." He goes, "I'm not doing well." He was dying. And he said, "I need to see you, and I know that you don't usually make house calls, David. I don't think I can really come in." I said, "I'll come to you." So I went to see him. I'll never forget when I pulled up and he came to the door. He was in a wheelchair, and that was a special moment. Fast forward, we talked about his situation and what he was doing and the investments that he had been put into that were to be, of course, all these wonderful things hadn't really worked out. In fact, he had missed out on a lot of potential growth when the market had gone up. The strategies that were being used really just did not do well. And he was disappointed. He was concerned about what the future would be like for his finances and for his family without him being involved and without him being there, and also with it not being maybe where he thought it should be. So we talked, and he asked me if he could come back, and I said, of course, we're happy to help. And so we took over the accounts, brought them back to our management, and the real key point of the story I want to share with you is he could have just let pride get in his way, having left and then calling to come back, but he didn't. And I'm very pleased to tell you that we continue to work for his family. Not long after he and I met, he did pass away, he did pass on, but today we continue to manage the finances for the family, and I'd like to think, in fact, I believe that his family and those financiers are in a much better spot than if it had been maintained the same way. But most important to me is that he had peace of mind, knowing that he had made changes and done the very best he could for his family in asking and putting aside any concern you might have had about calling up. So never too late to do the right thing with your money. And of course, if you do that, you know what I'm going to say, you'll plan stronger.
If you would like more information about the topics and our guests featured in this series, please visit our website at PlanStrongerTV.com. Also, if you have a question you would like David to answer, please send it to questions@PlanStrongerTV.com.